Happy Thursday, everybody. It's Andrew Cady with the Epic Mortgage team, powered by UMortgage. Thank you so much for joining me today. I'm going to take a bit of time here, and if you guys have been part of these presentations before, you know I tend to go through some really in-depth things, some very technical market analytics, but I always try to bring it down to layman's terms for you. So bear with me. We're going to dive into a ton of technical terms, but I'm going to do my best to break this down to something that's very palatable for you. What we're looking at is the rate and housing forecast for 2023. And this is going to be a big topic coming into 2023. There's a lot of big fears out there of recession looming and inflation and all of these topics. And it's really what I want to break down for you today. So we're going to start here. And the first thing I want to talk about is inflation driving mortgage rates. This is a very technical chart, and I want to break it down for you. So first and foremost, this vertical bar you see right here, that is a period of recession. You're going to see that on several slides today. When you see these gray vertical bars, that's a period of recession. That was the one that happened in early 2020. It was a very short-lived recession. The white line on this chart is the 30-year fixed mortgage rate. The blue line on this chart, or the teal line, this is core CPI. This is inflation, the CPI report, the Consumer Price Index, but core CPI is a very specific measurement that strips out food and energy. And the reason we're looking at that is because we're going to gauge the Fed's monetary policy. And the Fed's monetary policy really cannot control the cost of food and energy. Those things are much more driven by global economics or weather. You know, you could have a bad storm season that wipes out crops, that impacts food prices, or you could have weather in the Gulf that disrupts oil platforms, wars, things like that that are global or weather-based tend to impact food and energy a lot more than monetary policy. So this is core CPI, all the numbers for inflation, less food and energy. And what we're looking at here is generally going back in history, and you can extend this chart back to the 1960s, inflation and mortgage rates very generally follow hand in hand. When inflation goes up, mortgage rates go up. When inflation goes down, mortgage rates go down. And this is what we're looking at. And there was something that very interesting that has happened. It's the second time that we've really seen this happen. And I really wanted to break this down as to why we saw interest rates when inflation was rising in late 2021, mid to late 2021, inflation rates rising, but mortgage rates remained extremely low. And there's a very specific reason for it. There's something in the Federal Reserve does called quantitative easing. It's a big term. You'll see it on like CNBC and all these things. Let me break it down really simply. Quantitative easing is when the Federal Reserve steps in when there's a market, call it a market meltdown, a crash in the stock market, a recession, something major happens. What tends to happen is the market tends to spiral. Once it starts a downward trajectory, then, investors get scared and they start selling off more. And then even your seasoned investors start selling off as they see it crash. And so the Federal Reserve will step in and institute quantitative easing. Basically, when nobody's investing, they will come in and invest. And that's what we saw happen in early 2020. In fact, it was the largest quantitative easing in history. In just a window of 60 days, from March 20th, 2020 to May 20th, 2020, the Federal Reserve spent $2 trillion, yes, trillion with a T, not billion, $2 trillion on mortgage-backed securities and treasuries and bonds to stimulate our economy and to stop the free fall that was happening in the stock market. And it worked. And what we saw happen, obviously, when the Fed is spending money on that level, what they're doing is essentially creating new money flow. And with that will always come inflation. And you can see this period here. This is the quantitative easing period. They ran this much longer than expected and much hotter than expected. In fact, as of today, the Federal Reserve is sitting on a balance sheet of $8.5 trillion of mortgage-backed securities and treasuries that they bought and held. So what we saw here is inflation began to rise midway through 2021, but mortgage rates stayed down. Now, imagine it this way. Imagine if you put like a one of those exercise bands and you attached it to the back of a car, and that car started to slowly drive away, and you held that band as long as you could, the further that car gets away, when you let go of that band, the faster that's going to snap back. And that's exactly what happened with mortgage rates. Once inflation started to rise and the Fed was still buying mortgage-backed securities during this period, they were essentially holding mortgage rates down as inflation was running away. And as soon as they stopped, you can see this period where they stopped, mortgage rates took off. And in fact, it's one of the few times in history we saw this whipsaw effect. And I'll reference the whipsaw effect in future slides as well, so remember it. This whipsaw effect actually whipsawed mortgage rates over the inflation rate, the core inflation rate. And now you can see as inflation is beginning to come down, we're also beginning to see mortgage rates come down, but come down faster than we're seeing inflation. And inflation come down, and that's because of that whipsaw effect. It effectively jacked interest rates extremely high, but then it's going to snap back and it's going to come back in line, just like we've seen in history. Let's talk a little bit more about inflation. This particular chart here is one I've referenced in many presentations. Mega courtesy to Barry Habib with MBS Highway. He was the one who put me onto this. If you're in the mortgage industry, you don't subscribe, you absolutely should, but let's break this down. So this is currently the core CPI is currently at 5.7%. This chart is based on 6%. And I did that specifically because I want to see this June number in here and I want to explain something. So how is this, this chart is at 6%. As of last month, we're at 5.7. Right now, this chart's showing 6%. How is that 6% derived? Where does that come from? If all these little numbers on here, well, the way inflation works is you add up the month over month increases for 12 months and you get the annual inflation rate. So if you add up November through December, you're going to get 6%. And what we saw in June of 2022, we saw inflation start to drop. And here's how that works. When the June number comes out for 2022, it replaces the June number from 2021. And if that June number in 2022 is lower than 2021, well, the overall inflation rate dropped 0.1% in June of 2022. And we saw it all over the news. We saw people stepping up and saying, inflation has reached its peak. It's beginning to come down. We've beat it, blah, blah, blah. And we said, not so fast. And we said this back in June. We said, not so fast. The date you need to watch on your calendar is you really need to watch November 10th. November 10th is when the October readings come out. And the reason we were saying that is because we saw how low the readings were for July, August, and September. It would take numbers in 2022 of almost flat inflation to continue to see inflation drop. And we were right in our predictions on it. In July, it came out at 0.3%, which was a flat month over month. So it replaced the 0.3% with a 0.3%. There was no change in inflation. In August, we got a 0.6% inflation, and inflation replaced a 0.2%. Inflation shot up another 0.4% in August. September, 0.6 replaced 0.3. It shot up another 0.3%. But on November 10th, we got the October reading. And this was the one we were waiting for when we said we will have peaked inflation. October dropped 0.3%, and it replaced a 0.6%. And we began to see this number come down. November, 0.2% replaced 5. December, not on this chart, 0.3% replaced 0.6%. And we have gone past where we've seen peak inflation at this point. And so what we expect to happen, the next big date I want everyone to circle on their calendars is May 10th. And here's why. There's something that I want to talk about in the CPI report that's really, really detailed. But this May 10th number right here is going to be a big one. We expect to see some marginal gains in January and February. March, a little bit potentially, or a flat month. But on May 10th, we're going to get the April readings. And there's something really, really big that we expect to happen where we begin to see inflation begin to go down at a faster rate, really accelerate the downward trajectory. And here's why we're thinking this. If you look at the shelter cost in inflation. They're lagging massively. Shelter cost in inflation, that's owner's equivalent rent. That's the rent of homes. And what we're seeing on this is in the CPI report, this teal line here, it's still increasing. When you look at apartment list year over year rent, it's been decreasing. So how is this happening? How are we seeing one thing that doesn't line up? Well, I'm going to explain it to you. But I want to touch that shelter of all the line items in core CPI, transportation, medical cost, new cars, used cars, clothing, all these things. The shelter cost makes up almost 40% of the total core CPI. So when that number shifts and it begins to turn, we're going to see inflation decrease at a much faster rate. Every other item across the board, when you look at the CPI report, the core CPI, every other item is decreasing except shelter. It's the one thing that continually shows an increase. In fact, December's core CPI report showed shelter had the single biggest month over month increase in 35 years. Now, how is that possible? If you're in the mortgage industry, the real estate industry, if you're a property manager, you know that in December, we didn't have the highest increase in rents we've seen in 35 years. So what's going on? There's a lag that's going on, and that's what I want to explain. What we can tell by the data is that shelter costs are lagging in the CPI report by anywhere from 6 to 7, 8 months. So what's actually happening is much like a roller coaster. You have the real shelter cost on the same exact ride at the top of the hoop. You can have people that are still going up, going down, and people at the top. And that's really what's happening right now with shelter costs. Shelter costs are actually on the way down. Really, the peak was about January, but the shelter costs in CPI are still rising because of the lag indicator and how long it's taking to come into this. There's another reason we believe we're going to see interest rates decrease with inflation at a faster rate than what some of the big economists are predicting. The Mortgage Bankers Association, they have some of the best economists in the country. They're predicting a 5.4 median fixed 30-year interest rate by the end of 2023, 4.5 by the end of 2024. We tend to think it could decrease a little bit faster than that. And here's why. This chart is a really, really interesting chart. Again, courtesy of MBS Highway. If you look at the 10-year treasury, that's the white line, and the teal line is the 30-year fixed mortgage rates. Now, this is going back decades here. If you just pick random points in this measurement here, generally, these two are going to be about 175 to 200 basis points apart. In interest rate, that would be 1.75 to 2%, meaning the 10-year treasury historically is at 5%. Mortgage rates should be somewhere in the 6.75 to 7%, a percent and three quarter to 2% higher than the 10-year treasury. This whipsaw effect that we talked about earlier is one of the things we've seen. With mortgage rates skyrocketing, they've actually surpassed up above that 175 to 200 basis point mark to 300 basis points, 3%. We saw the 10-year treasury peak out at about 4.3%. And at the same time, we saw mortgage rates peak out at about 7.3%. So we've seen this go from a 1.75% spread to almost 3% spread. But what we're starting to see on it is that spread is starting to come together, and it's coming together really nicely. Like if you look at the data today, we're down to about 2.6% spread. And so as inflation drops, we're also going to see a further drop in rates simply because of the whipsaw effect of what happened with rates, how fast they went up. They're also going to come back into this 1.75 to 2% range. Now, let's go on to the next slide. This is the big R word. Nobody likes to talk about recessions and what might be coming. But if you talk to any of the economists out there, there's a very, very high probability of a recession coming in 2023. The Federal Reserve has this wonderful dream of what they hope to achieve as a soft landing. A soft landing meaning they tame inflation without tipping our economy into a recession. And most economists agree that that is simply beyond the point of possible at this point. There is going to be some level of a recession. How deep that goes is really going to depend on what the Federal Reserve's next moves are. So, what are we looking at for a recession that could be incoming? Well, we look at indicators of why we might be getting a recession. One of the biggest indicators right now is that credit card debt is at an all-time high. In fact, it's almost 15% higher than it's ever been in history. And we know why. Americans are being pinched by high inflation, and it's growing faster than their wages are growing. And ultimately, it's leaving a lot of people in low to middle class families buying their groceries on a credit card, running their credit card balances up simply to live. And so credit card balances are peaking out. At the same time, personal savings are reaching an all-time low. So people are depleting their savings and they're running up credit card debt. But at the same time, that credit card debt, with inflation rising and the Fed raising the federal funds rate to combat inflation, their interest rates on their credit cards are going up as well. And that's hurting the monthly payment and ultimately just making the problem worse. The monthly payment gets higher, they put more on the credit card to pay the payment. And it's really a cycle that's concerning when you look at the overall economy. The other item we look at on incoming recessions, this is probably the strongest indicator of a recession going back in history, is a yield curve inversion. Big word, again, big term. Let me try and break it down for you. A yield curve inversion is if you take your money to the bank today, you go in and you say, I want to take a 1 month CD out, the certificate of deposit. That 1 month CD is going to pay you less rate, less yield than it would a 1 year CD or a 2 year CD. The longer you let the bank hold your money, the higher the yield, the higher the rate they pay you. A yield curve inversion is when the treasury markets invert, meaning right now, as it currently sits, if you bought a 1 month treasury versus a 10-year treasury, the 1 month treasury is going to pay you over 1% more yield, 1% higher rate of return than a 10-year treasury. That's a yield curve inversion. We typically watch when the 10-year inverts with the 2-year. That's the biggest indicator that we're going to get a recession. When it gets to the 1 year and the 3 month, it's really knocking on the door. Again, you can see the vertical bars here are periods of recession. This line right here, this is the zero line. And you can see we dip below it in the late 1980s, boom, recession follows. We dip below it in the early 2000s, recessions follow. The big recession of 2008-9, we dip below it again. Right before 2020, we dipped negative, inverted yield curve again, recession. Right now, we're extremely inverted in the yield curve. We're looking back at the 2000 levels of an inverted yield curve. So we're definitely looking at some level of a recession coming at us in 2023. So what does that mean for housing? Because that's really the big question. If you're watching this, you're probably in the housing market. So what does it mean for housing? Well, I have good news. If you go back to literally 1960, every single recession we've had, with the exception of the recession of 2008, was an increase of home values during the period of recession, not a decrease. Why is this? Well, the biggest reason is during periods of recession, mortgage rates tend to drop and it makes housing more affordable. Buyers that are on the sideline come into the market and more demand creates higher prices. So we typically see, you can see this one here, this is the anomaly. Let's talk real quick about 2008, 2009. That was not a normal recession. Let's face the facts. That was a recession that was brought on by the housing market. That was a recession that was brought on by horrible lending practices. If you had a pulse, you got a mortgage. I mean, honestly, if my dog stamped its paw print on a napkin at a bar, it could have got a mortgage in 2004 and 2005. Anyone and everyone was getting a mortgage. And that was the subprime days that really led us into this crash. So historically, we don't see home values drop. And you say, well, this run up right here looks awfully similar to this run up right here. And yes, that is pause for concern. There's always those possibilities. But I do want to break down something else. During this period here, we had a mass over amount of homes being built. In fact, the numbers are from 2010 to 2020, home builders built almost 80% less homes than they built from 2000 to 2010. And what that's equated to is 14 million households have been created with 3 million fewer homes. So we have 14 million more households with 3 million fewer homes available. And right now we're sitting at all-time record low inventory. This is dating all the way back to the late 80s. We haven't seen inventory at this level in a very, very long time. And you say, well, I'm a real estate agent. I'm not, we're having to reduce the price of our house right now. Yes, that is true. What has happened is affordability. Affordability has happened. A lot of people have been pushed to the sidelines and they simply can't afford that $300,000, $400,000, $500,000 home because of where interest rates are at. But make no mistake, just because a buyer is on the sideline doesn't mean that they're out of the game. The housing market is one of the strongest rebounding things in this country. When we see interest rates come down, we do believe with everything in us that we're going to see buyers come out of the woodwork and come back to market. And if builders are slowing down right now, it's only going to compound it. And supply and demand is going to ultimately govern where this goes. Let's look at new housing supply. New housing starts completed 1.5 million that we have to also take into account that replaced on an annual basis. So replacement on an annual basis, these are homes that age out. Around 100,000 homes a year have to be torn down and replaced. And so you're not necessarily creating a new home. So if you're completing 1.5 million housing starts per year, you're only getting 1.4 million housing supply out of that, but we're at 1.3 million new household creations per year. And if you look at that number, the most recent data from the National Association of Realtors shows that we're somewhere between 3 and 3.5 million homes short for current demand. This is because of what we talked about earlier, the builders underbuilding between 2010 and 2020. So if we're that far short and we're only gaining ground by about 100,000 homes a month, it's going to take us 3 to 5 years of building at our current pace just to satisfy the current demand. And the most recent builder numbers we're seeing are builders slowing down, not speeding up. So supply and demand is ultimately going to come into effect. When rates come down, we will see buyers come back out of the woodwork on a massive scale. Home price moderation. This is hardly a crash. If we look at, from 2013 to 2020, yes, in the last 2 years, we're up 39%, and we're down an average now of 2.5%. This is hardly a crash. Now, you're not going to see that in the news headlines. What they're talking about in the news headlines is home values decreasing, home values decreasing. But it's important to understand and to educate your clients that this isn't a crash. Definitely a bit of a correction, but not a crash. If you would have bought a home in 2013, you're up 115% in value just in a matter of 10 years. That's a massive, massive return on investment. There's an interesting chart. I don't have it in this slideshow, but it's an interesting chart. If you guys want it, you can connect with me. But it basically shows the average net worth of a homeowner versus a renter. And it's such an interesting chart because you can't find the line of the average net worth of the renters because it's actually the bottom of the chart. Homeownership is still one of the greatest tools, and it is ultimately the greatest tool to combat low net worth. And so explain that to your clients. Explain that to people that are looking to buy a home. Let's talk about affordability because this is a really cool slide. This thing a lot of people don't talk about. If you would have bought a $400,000 home last year at a rate of 3.5%, your monthly payment would be $1,796 per month at the average household income of $9,000 a month. This year, at 10% appreciation on that home, your loan amount would be $440,000 at a 6.25% interest rate. You're talking a $2,709 monthly payment for the same home. You're almost $1,000 higher, $913 higher. But we also have to take into account that there was an average of 9% increase in household incomes in the last year as well. The sources on here are from ADP. If you stayed at your job in 2022, you averaged a 7.6% increase in pay. If you switched jobs in 2022, you averaged 15.1%. It's an average of 9%. So of that $913, $810 is made up just in increased earnings. But we're not going to stop there. Let's actually look at this because, yes, gasoline, food, services, all these other things come up with it. But if we get just a 5% increase next year, simply a 5%, we're going to get a $1,300 increase in household income, combating an $1,154 affordability issue. And that's not even counting interest rates decreasing. So what we expect is $440,000 home value to hold, a 5% interest rate. That's an $807 difference in payments, all in, at a $1,300 difference in income with a 5% increase in household income. So it's honestly, you've got to read a little bit deeper into the news headlines that you're being fed on some of these things. Let's look at housing forecasts. We're about done here. I got a couple more slides, so bear with me. Want to dive into just what we're looking at for next year. What we're looking at is we're looking at lower inflation. We know that's going to happen, and we expect it to be May 10th is going to be the bigger day where we start to see inflation increase its speed on the downward trajectory. We definitely expect a recession-like slowdown. We expect things to slow down. We expect this economy to slow down. We expect incomes to increase, and that's going to help the affordability issue. And we expect a very, very tight inventory issue coming back because home buyers that are on the sideline with interest rates coming down will be back in the market, and the homes simply aren't there for them to buy. We're actually seeing a lot of people in a lot of markets just over the past few weeks have started getting back into multiple offers again. We're not seeing necessarily going up and above asking price, but I've said it before, I'll say it again. If you are waiting for interest rates to come down to buy a home, you're essentially waiting for home prices to go up before you buy the home. If you like the home, buy the home. If rates go down, you can always refinance your mortgage. You still get the home at the value it is today. If rates come down, if we had a sticker shock and we saw 4.5 at the end of this year, don't quote me on that. I don't think we were going to get that low, but if we saw 5, 4.5, the market's going to be flooded and we're going to be back to multiple offers. We're going to be back to highest and best. So if you're in the market to buy, if you have clients that are in the market to buy, explain that to them. Rents are still rising. We know that landlords, 1 out of 7 single family homes in America is now owned by a corporation. Rents are no longer being set by the mom and pop landlord. Rents are being set now by hedge funds. They're being set by Wall Street. And we know Wall Street, if there's a penny to squeeze out of it, they're going to get it. And mom and pop landlords are also going to keep up with what their neighborhood home is renting for that's owned by a Wall Street hedge fund. We expect low to single digit appreciation in the United States across homes, anywhere in the 2 to 3, maybe 4% appreciation in home value. In some markets, we expect home values to decline. There's some markets where it's gone over and above where it should be. A lot of the markets, though, are not in that situation. Mortgage rate forecast. Let's talk about that. The headwinds we're going into, these are the things that are going to push back against us. Global quantitative tightening. We talked about quantitative easing. That's where the Fed comes in and buys mortgage-backed securities, treasuries. Quantitative tightening is where they stop and they begin to let their balance sheets roll off. That's what's happening right now. And we're going to see that on a global scale. If we see quantitative tightening where they, instead of investing into their economies, divest from their economies, it's going to push hard against the mortgage rate environment. We're going to have a lack of central foreign bank buying. Foreign banks buy a lot of U.S. Treasuries, mortgage-backed securities. And we're going to see, if we enter recession periods, that's going to slow down. And there's a lot more debt that's going to be financed. Americans are debt-laden right now. And that's something we have to be very cognizant of. The tailwinds, the things that are really going to help us going into this environment is going to be lower inflation, excess retail inventory, increase in mortgage servicing value. Let's talk about that. Servicing value is a very, very big thing that hurts interest rates. And I'll explain it as just layman's terms as I can. If you're an investor and you're investing into a pool of mortgage-backed securities, you typically expect the refinance time on those loans to be somewhere from 5 to 7 years, meaning you're going to earn a profit on your investment for 5 to 7 years. Over the last year, as interest rates increased so fast, investors started investing less and less and less and wanting much, much more return on their investment because they know someone who's got an interest rate that's locked in at 7%, if rates drop at all in the next year, they're going to refinance and their investment's going to go away fast. It's not going to last that 5 to 7 years. And so the servicing value of mortgages has just fallen off the face of the earth. With lower rates coming into play, those values are going to increase, which is ultimately going to help mortgage rates come back down. We're going to see a recession, very, very likely. That's going to help mortgage rates. Historically, every recession we have seen has helped mortgage rates because rates decline during times of recession. We expect the fixed 30-year mortgage rates to move near 5%, 5, 5.25, 5.5 in the first half of 2023. We expect the 10-year treasury to drop below the 3% mark. Last week, we tipped just below 3.43, which is a very, very strong level of resistance. We've broken back above it again. But once you break below that, it opens the door for it to happen again. So I do think we're going to be on a really good trajectory going forward into 2023. That's all I've got for you guys today. I appreciate your time. If you guys have questions on this, if you need assistance, reach out. This is what we do all day, every day. UMortgage is a platform that connects loan officers really with the future of loan origination. Reach out to your loan officer, reach out to your UMortgage team if you guys have questions. I appreciate your time and have a wonderful rest of your day.